And the next question on the Get Ready for the Future show is from Carrie in Little Rock, and it's very similar in a lot of ways. She writes, I've heard a lot about the 60-40 split and that it's a good investment mix. What are your thoughts? And how do I know how much money can I safely withdraw from my investments each year without running out of money? Well, thanks to Carrie. And the 60-40 split, that is an asset allocation portfolio. We have talked about that many times on the Get Ready for the Future show. So now we talked about income versus growth in the equity asset class, but now let's talk about two different asset classes. So in this 60-40 makeup, it is typically 60% equities, so it could be a mix of income and growth. It's just 60% equities and 40% fixed income or bonds. So now when we get into that managing risk component again, John, typically the fixed income component of that 60-40 split is the quote-unquote safer or more stable part of your portfolio, but it's not always the case.
No, and I would really draw an analogy here, Scott. Think about an orange, and let's think about that orange with the peel removed, but maybe you slice that orange in half and take a look at it, and you see those segments. That's what an asset allocation portfolio looks at, those little wedges all put together and different variations of that. So think about a 60% wedge being equities and a 40% wedge being fixed income or bonds. So if you're selling off of that 60-40 portfolio and you're just taking a pro rata distribution from that, then you are engaging potentially in reverse dollar cost averaging, meaning that you're going to sell those equity shares maybe at an inopportune time to create the income. Just exactly what we talked about before. So what we think about in terms of that orange is not having the orange all put together in one circle, but actually folding it open and splitting it open. And you know, you've probably done this as a kid, Scott, is you take that orange and lay it out on the table, and you've got each of those segments laid out on the table and picking up a bite-sized piece and eating it. That's essentially what a bucketing strategy does. By being able to consume, if you will, that fixed income part of the portfolio first, it allows those equities to grow. And that is the difference between a 60-40 portfolio and a bucketing strategy. Now, let's kind of delve into this a little bit further, because Investopedia, which is a great source of basic financial information online, they say that a 60-40 portfolio no longer is keeping up with today's market environment. Now, it's really interesting here. They talk about alternative investments. Catch this: hedge funds, commodities, private equity. Anybody a holder of those things out there? Very few folks, right? Because those things, Scott, those types of alternative investments tend to be for high net worth people. And if you haven't had any experience, if you don't really understand how a hedge fund works or how private equity works or anything of that nature, you could be buying more trouble. And frankly, sometimes hedge funds and private equities are equities just by a different name.
Yeah, and alternatives can have a place in someone's portfolio.
Absolutely.
We do certainly use some of those here at GenWealth. So I do think when I hear 60-40, that is a little bit restrictive. You know, it's not just two asset classes that are available to you. Maybe inside of your employer plan, right? Inside of your 401k, that may be the only type of asset classes. The other thing we don't know from Carrie here is how old is she? You know, we're talking about withdrawal strategies from a 60-40. A 60-40 is typically a portfolio that is recommended, in the past it has been, for people nearing or in retirement. Certainly if Carrie is younger, so for the younger people listening here, if you're not planning to withdraw any money from your retirement assets anytime soon, you're trying to accumulate, you're trying to build, you want to probably be a little more aggressive than a 60-40 portfolio. And one of the main reasons, John, you want to do that is when you are contributing. You were talking earlier about what is known as sequence risk. When you're withdrawing money as a portfolio is losing value, you're selling more shares at a discounted rate. The reverse is true when you're putting money into your retirement savings.
Yeah, and I think about it, Scott, like you just want to take what the market environment is going to give you. You know you're going to get volatility in the short term from equities, from stocks. But in the long term, you know the longer you have those equities invested, the higher the probability is that you're going to get a decent rate of return. As a matter of fact, there's never been a 15-year period of time in the S&P 500's history that you had a negative rate of return. You go out 25 years, the worst rate of return is somewhere in the 7 to 8% range. And so when you think about your portfolio, and even if you are approaching retirement, you've got to have a growth component to your portfolio to help keep raises going for you in retirement so you can keep up with the cost of living. So an equity portfolio is definitely something that you want to do. What we do not subscribe to, Scott, is kind of mixing those all together into one portfolio. We believe in segmenting that portfolio out into different asset classes and then rebalancing that portfolio as time goes on through waterfalling profits over into the fixed income accounts so that you can consume those. Another way to think about this is almost a plant, grow, and harvest type strategy, where if you kind of think about what a farmer does, he plants the crop in the field. He tends to it over a long period of time. He grows it, and then he harvests that crop, puts it in the storehouse, and then consumes it at the kitchen table. That's the same type of strategy that we would look at to use equities. We want to grow them over a period of time, take the profit from that, and then consume that out of the storehouse, which would be your fixed income type component.
So important, I think, to point out, too, our first two questions today on the show have been about investments, but they have been standalone questions. Investments are extremely important, and they are unique. An investment strategy is unique to you, but it only is developed through the ready-to-retire process or to the accumulator phase through a plan, a written plan on paper on purpose. We have to know where we're going before we can really try to place the roadmap out there on how to get there. So they're good questions, great questions, and we hope we gave you some education in answering them and kind of talk through that. But the ultimate answer is, for Keith or for Carrie, it's not the 60-40, it's not the mix of income versus growth that should be the first question to be asked.
Everything should peg off a strategy.
Yeah.
If you don't have a strategy, the investments don't matter. If you do have a good strategy, then the investments will matter, but you need to have them allocated in the right way.
So if you got questions for us on the Get Ready for the Future show, you can call or text them to us at 501-381-5228 or send us an email. Just send it to show@getreadyforthefuture.com.